Good afternoon and good morning, ladies and gentlemen. Welcome to Exploring the Real Estate IRA. I am your co-presenter, Jim Jones, Business Development Manager with the Entrust Group. Before we begin, I'd like to read the disclaimer. The Entrust Group does not provide investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Again, I'm your co-presenter, Jim Jones. And at this point, I'd like to turn it over and introduce the other co-presenter today, Nick Aalerud of AA Real Estate Enterprises. Welcome, Nick.
Hey, Jim. Thanks so much. I appreciate it. Welcome, everybody. We have a great group today. And I'm hoping that at least some people can get a few nuggets out of what I have to offer. Jim and I have been working together now for a little over a year, and it's been a fantastic partnership, we feel, from a financial perspective with self-directed IRAs and real estate. So if you're with me, we'll take you through a quick journey as to what I do on a daily basis, and it's a lot of fun. First of all, you might be asking, well, who am I? We're from the Boston area. I'm a former investment banker with Mellon Financial and Bank of New York, Mellon. Active real estate investor since 2005 in 7 different states. And we've completed over 100 projects, and we hold a portfolio of over 235 units in 3 different states. So a lot of people on this call, and when we do this talk, most people are familiar with a lot of the regular financial investments. And that's where I came from the stocks, bonds, and mutual funds world. So let's talk about that for a second. Everyone on this call, a lot of people are probably very familiar with economic cycles, up, down, ugly, good looking. We have right now, of course, as we all are aware, we're in a pretty depressed market, which a lot of people look at as an opportunity. Now, when the economy is booming and there's consumer confidence is very high, the whole market's flocked to the financial world. They flock to the stocks, bonds, mutual funds, derivative trading. Occasionally, if things are really good, they'll even flock to subprime loan bundles, and we'll buy those in bulk. That's one of the reasons why we got into the problem we are in today. But when the economy falters, that's when we see an awful lot of people flocking from the financial aspect, from that realm, into tangible assets. So precious metals, commodities, that's where people are kind of flocking to when this economy started to dip very quickly. And one thing that I really, really felt strongly about is from working at the bank, I really like the idea of having a tangible asset as my investment. So that was the big benefit that I found when I switched over. So our next, to talk about the benefits of real estate as a tangible investment, many of you love the idea of actually being able to see, hear, feel, and touch your investments. And I did not like the idea that when I was in the banking world, I could make the best trade I possibly could, and through all the fundamental and technical analysis, I could do all the research I possibly could do, make the trade, and then the next day come into work just to find that either there was a bad earnings report that night, or that the CEO had just been caught in an affair with somebody else, and it plummeted the stock price. And I'm the one held responsible for that, having no control, zero say in what happened to that move. So benefits of real estate, number one, it's tangible. I can feel, touch, and taste it. I love it. It's something that even if everything goes to hell, it's still going to be there. I should probably... Sorry, guys. I'll watch my language in this call. We're from Boston, so we're pretty rude up here. Financeable and use of leverage is another way to do it. There's a great story that I think I read somewhere or someone else told me. And they said, I want you guys to imagine walking into a Bank of America, and you sit down with the banker, the loan officer at the table, and you say, you know, Steve, here's the deal. I want to take out a loan for $100,000, and I want to use it to invest in your stock, in Bank of America's stock. The loan officer, of course, will look at the person asking for the money and say, well, no, I can't do that. The answer is, if you ask, it's because it's a risky investment. Bank of America will not loan money on their own stock because any stock is considered more risky than real estate or tangible assets, which is why I love that I can go into a bank or a lender facility and actually finance and leverage the tangible asset in order to get the best return on my money. Third is insurable. Everyone says, what's worst case scenario? Well, one of the worst case scenarios is that my investment goes down in flames. If there's a fire of some sort, and the best part about that is if it does go down in flames, we get a check. That's one of the worst case scenarios in real estate, so I really appreciated that. Non-efficient marketplace. Stocks, bonds, and mutual funds people are very familiar with the stock ticker that goes up and down every split second. Within 1 second, everyone across the world knows exactly what a ticker is going for, second to second. Non-efficient marketplace means that potentially I might know about a great deal down the street on Adams Road where Granny Smith, I know, just had to put her husband into an elderly care facility, and she might need cash very quickly. And in order to do that, I am able to come in and purchase her house quickly for cash. And in doing that, I would get a discount on my purchase. Now, it's not something that the entire world knows about immediately. It's something that is opportunistic. Whoever's in the right place at the right time and is prepared when they meet that opportunity, that's when they're going to make a deal. I like in real estate that risks may be lessened. Instead of, like I just mentioned, where the CEO might be having an affair plummeting the stock price, I have some sort of control over some of the variables that I use when I go into a deal. I know now when I go into a deal around how much construction it will take. I know an exit strategy. I know I have team members now that through all of our best guesses can accurately predict what I can either resell that property for to a retail market or resell it to an investor market. There's a lot of risks that can be lessened in real estate, being construction and the numbers. I'm very, very numbers oriented, just like everything else. Stocks, bonds, and mutual funds people use formulas. So do I. Every day we come in, we have very strict rules we adhere to, and if the deal matches our criteria, we execute on it. Finally, tax advantages. Again, most people on this call are very financially educated, know about the tax advantages of real estate. One being depreciation. There's an awful lot of offset to passive income. I'm not a CPA, and I should probably have started with this, as Jim did a great job with the disclosure and disclaimer. I'm not a CPA, attorney, or financial license. Don't hold any licenses in any way except a real estate license. And so anything I do say in regards to taxes or investment advice, you need to consult with your own tax advisors and financial advisors. But tax advantages of real estate I found to be excellent, and they do offset an awful lot of things that I'm looking for in my earned income world. So how do you get started involved? How do you get your IRA involved in real estate? There are 4 main strategies: wholesaling, rehabbing, buy and hold, and private lending. These are in order based on the level of involvement you want to be. Some people have an awful lot of time and they want to have this their full-time job. They want to go out and check properties out every day and manage contractors or meet people and network. In that case, they want to start at the wholesaling or rehabbing side of it. If they're someone who either has a full-time job or semi-retired or really doesn't want to have to devote that much time, but instead would like the returns that real estate can offer, they would probably go into the buy and hold and private lending categories. So I'm going to go through real quick a brief analysis of what each of these strategies entails so that everyone gets an accurate idea in how to use their IRA to do that. The first one, what is wholesaling? A lot of people are surprised when I go over this who are not familiar already with the real estate industry. Wholesaling is when it's all about finding the deal. This is a very, very active, you need to spend an awful lot of time on this from a week-to-week basis, a minimum of 10 to 15 hours a week, and you can really ramp up your business when you go to 40. But you're finding the deal through marketing efforts, motivated sellers, people who need to sell, not who want to sell. And in doing that, you provide them a service by purchasing their house with quick cash, usually no contingencies. You're helping them with a fast sale, and in exchange for that, you get a discounted price, which now, if you get it discounted enough, you take that piece of paper you just negotiated, which is your offer to purchase or your purchase and sale agreement, and you take that piece of paper and go and sell it to someone else who's going to go through with that closing, someone like me or another rehabber or another construction person. They're going to take that offer and honor it and pay you a fee for having found and negotiated that deal. It's called an assignment of contract. The best part about this is, in order to do that within your IRA, all you have to do, you're essentially creating income from nothing if you know how to do this correctly. You write your sales contract in the name of your IRA. So in this case, you'd you can check with your Entrust customer service to figure out what the best way to entitle it is. But if you go into a deal, all you have to do is sign it. Make Aalerud FBO Entrust. I'm trying to remember how it's entitled, Jim, and maybe you can help me with that when you get back on the line.
It would be the Entrust Group for the benefit of your name and your IRA account number.
Oh, perfect.
As opposed to you personally.
Cool. I'm glad you're still on too. I didn't know that. Great. That is the proper way to entitle the offer to purchase or your purchase and sale agreement. And once you have that in writing, you can then take that offer or that purchase and sale, go out and sell it for a fee, $5,000, $10,000, whatever you have deemed worth it. That still leaves money in there for the next person. So, for instance, you get a property under agreement to make numbers easy. I know this varies state to state very, very much so, but a property gets under agreement at $50,000. You know it's going to take $40,000 to fix it, and it's going to resell for $150,000. This is a simplified example. So you also know that I need to make $30,000 on my investment. I'm one of your buyers. I'm a rehabber buyer. You're going to negotiate that price so that you can purchase that and have the purchase price be less than the resale value, so my $150 minus my construction, so $40,000, we're down to $110, minus my minimum profit, we're down to $80. And if you've gotten that deal under agreement at $50,000, you now have a $30,000 spread where you can either charge me for it or you can buy and sell it yourself. And that's the last part of wholesaling. You can actually take title in the name as a wholesaler, buy and sell the transaction within your IRA. That's when you actually close, and there is some risk involved here, but there's usually a larger return when you do that, $30,000 to $50,000 when you buy and sell the property to cover closing costs and whatnot. The biggest part here is to remember how to entitle the purchase and sale agreement and work very closely with your Entrust representative as to how best to take title and your attorneys to close on this deal and resell it, or to just sell the paper that you've negotiated. At this point, I usually give Jim a lot of credit. The one thing we love about Entrust, which I'm sure he's going to go into, is the checkbook control, which I'll let Jim talk about, but it's one of the best and easiest ways I've found to be able to invest in real estate through the IRA. Our next, we'll talk about wholesaling. Let's see here. I'll figure this out. There we go. All right. So we went up through wholesaling, which surprises a lot of people. Rehabbing Business, which a lot of people know. Everyone's seen Flip This House TV show with Dan Merrill and them. They had a great TV show going. That's exactly what it is. Understanding your numbers is the key point here. Buying very, very low. Effectively managing the job, your budget, and your contractors. And then you sell retail. So I always like to say buy low, sell low, instead of buy low, sell high. I always like to underprice my properties because it helps me keep a safe amount so I can get in and out of a property quickly, and it also ensures that I'm buying correctly, and that's the key to this. Make sure we buy as low as possible. Forced appreciation versus speculative appreciation. A lot of people heard of the people buying for speculative appreciation back in 2004, 2005. that was for people who wanted to buy, hold on to it for a year, maybe not do any work to it, and then resell it for a profit, which they could do up to a point until the market turns. Again, I don't like speculative appreciation because I can't really control that variable. Forced appreciation, however, is when you go in there and physically improve a property. A contractor or a property manager goes in there and physically improves a property, especially when dealing with IRAs. Jim will get into that when he has his talk. But you can always improve the value of a property, of course, through rehabbing. So the systems version, I'm a very big systems guy for those who know me in my business. It's broken down into three: due diligence and acquisitions. So how do we buy it? What variables are we able to control? We can go to the town hall. We can see what type of citations there might be on the property. We can see if there's an underground storage tank or a record of one ever made. Project management. How do we control our contractors and construction people? How do we make sure that they don't give us change orders of over $50,000 on deals when we haven't authorized it? How do we stay in budget? And then the resale liquidation, which is how do we properly market effectively and sell quickly. Our goal here in my company is to sell our properties within 14 days after they go on the market. Some of you nationally may say that's incredible, being that we're still in a down market, but if you price it correctly and you have high craftsmanship and really good work, people will still buy it. That's what they're looking for, especially first-time home buyers in this market. Here's the part where I get to shamelessly go through a whole bunch of properties that we've done before. These are in Framingham, Massachusetts. That was a small ranch that we did. This was in Natick, Massachusetts. It's a nice suburb of Boston. That was an awful property. We had an interesting problem with the structural from the foundation. We ended up going over on that property by about $25,000, but because we bought correctly, we were still able to get out with a nice profit. Here's a good picture where we bought this property and we found out that the wife wanted to put a fireplace in their dining room. So instead, the husband kept disagreeing with her. She did it anyway, and as you guys can see, the gas exhaust, she just vented it right into the little three-season porch where he used to read. We thought that was kind of funny. We turned that into that tiled extension room. And we always stage our properties too, because we find that that does provide much better value, and it helps them sell quicker. I see an awful lot of questions coming through about UBIT taxes and a whole bunch of things. I'm leaving a lot of that for Jim and I to answer at the end, but there are very important questions, and we do want to make sure we address those as best we can. So I appreciate the questions, guys. Keep them coming. Buy and hold investing. Buying for cash flow and annual returns. I want everyone who's financially minded to really think about this. When you buy a rental property, you can literally dictate to yourself how much you need to make, or your IRA needs to make per month per unit in your IRA. It's an incredible thought to think that you can actually dictate that to yourself, and by dictating that to yourself, you actually know exactly how much you can pay for a cash flowing multi, or for one that you're going to be purchasing, rehabbing, and renting out. Here we strive to hit $250 per unit per month for net cash flow. Okay. I see another couple questions coming through. We'll get to those later on at the end of the presentation. But they're great questions. Those are awesome. So buy for cash flow, annual returns, long-term investing. This isn't more passive, but it still requires an active management aspect to it where, Jim will get to who can actually manage and who can't. But you do need a property manager. You do need someone who is able to be able to run out there and answer the tenant calls and that sort of thing. So the benefits to buy and hold. Plan your return and your exit strategy. Are you going to hold it forever? Some people like to hold ATM machines. They just pay rent over and over and over again per month if they're properly managed, and they get checks every single month until they're ready to start taking distributions and whatnot from their IRA. Diversify the portfolio. A lot of people, there's a joke between me and a few of my colleagues here in Boston where diversification to us isn't even necessarily going stocks, bonds, mutual funds, and real estate. We diversify by saying, I'm going to hold this many units in Boston, this many units in Pittsburgh, this many units in Atlanta. So diversification from both the tangible aspect of real estate as well as providing a nice long-term wealth-building strategy for yourselves. And you can define your investment goals. You can say, I want to make this much per month with my rental units. The challenges with buy and hold, of course, who wants the 3 a.m. phone call with the tenants, toilets, and trash? You know, hey Nick, oh it's me, Joe again. I'm just here calling. We got another issue with the toilet. No one wants those calls. A lot of people might be surprised that there are effective property management companies out there that are able to take those calls for you. They're able to lease out your units. They're able to handle all maintenance calls. And at the end of the month, you get a statement with a check mailed to your address. And all your job is to manage your manager. The biggest part here is just to ensure that the cost of your property manager is worked into your buy price. So if you need to make $250 per unit per month on your rental, make sure that that includes in your expenses about a 6 to 10% management fee, depending on where you are and how many units. Okay? The last strategy I was going to go over is private lending. This is the most common that I see with IRA holders and Entrust clients. We work an awful lot with Entrust clients that just don't really want to have anything to do with the real estate. All they're interested in is the solid return that they can make, secured, either secured or unsecured, but it has real estate as a security possibility, and it has investment sponsors that bring deals to them. There's many different ways they can private lend in real estate. They can just be a debt lender. They can partner with people. They can buy and hold. They can partner with people that are going to be buying multis for cash flow. And there's also people out there that raise money for the larger acquisitions, 100-unit plus apartment complexes. But all a bunch of different strategies here. The benefits of a private lender are that it requires no active participation in the deal. So they can continue working full-time and running their businesses, or if they have a very 80-hour work week like I used to at the bank, they don't have to really worry about things. Least time intensive. The returns may be favorable and potentially much higher than traditional money markets and CDs that people are used to. I like to say it's potentially much higher than a lot of the mutual funds and bonds out there. You collect checks on a payout schedule with no contractors to manage. So if you're dealing with construction or rehabs, you don't have to worry about managing budgets or workflows. The deals come to you, so you don't need your own deal flow engines. And this was the toughest part for me. 3 years, we've been in this business for 7 years, and for the last 3 years, we've been really working on our deal flow engines to get deals to come into our office over and over again without us having to do, with only us having to do minimum amount of effort to get that to happen. That's the toughest part about finding the deals. In some cases, when you're a private lender, losses are limited depending on your investment structure. And here's least susceptible to UBIT taxes, but again, consult your tax planner for confirmation on that. And I know neither Jim or I are CPAs, but we can probably try to address that as best we can at the end of it with that disclaimer. So the challenges of private lending is that, of course, you have to do your due diligence on your manager. You have to ensure that what they're offering fits in with your financial goals. So if there's an investment sponsor there and he's offering you an investment of 1 year, and you know that within 6 months your elderly parent's probably going to have to go into a facility, maybe that's not for you. Or if they're offering you a 3-year investment, you certainly want to make sure that you don't have to send your son John up to college in the fall. It's just making sure, and also making sure the returns are in line with what you're expecting. Long-term versus short-term. Buy and holds typically long-term, and short-terms are a lot of rehabs and wholesales. But with shorter-term and higher investments, everyone knows usually risks do go up. Ensure you agree with their business model. How are they making money? How are they buying property? How are they holding property? How are they managing their entire business? Those are all very good questions to ask. Some people who do know me might know that when I started in this business back in 2005, I was in a very poor partnership out of state with someone that I thought I had done a whole bunch of due diligence on, but it turns out, because I didn't know much about real estate and I didn't know much about him or what I was doing, we ended up buying 5 properties with him, and all of a sudden he ended up walking away from all 5 of those deals. And my colleague here in Boston and I were left holding these 5 properties we didn't know what to do with, we didn't know how to fix, we didn't know how to manage or anything. And that experience taught me an awful lot about filtering my investment sponsors and learning how to take care of things, how to make sure I am as safe as possible when making these investments. So the conclusion for real estate, I hope that we've shown you today that it can be an effective alternative investment. You determine how hands-on you want to be. So there's active versus passive investing. How much time do you have per week is that question. And there's also short-term versus long-term investing, which we just went over. So the biggest tips we have for using your IRA in real estate, I want to give you guys a nice example too that we see frequently, which a lot of people maybe don't even comprehend. The best way I've found to really build wealth is through my IRA. Whether it be a Roth or traditional, I like Roths better for reasons a lot of you may know. I can go to, let's say I'm wholesaling. I can take a piece of paper, I can find a deal through my marketing efforts, direct mail, whatnot, go out, get a deal together, sign the contract. I can then take that contract and sell it to my buddy. I have a friend named Gal who buys a lot of properties. I'm going to sell this to my friend Gal, and he's going to pay me $20,000 for that property because I found him a deal, and he still makes $20,000 to $30,000 after he fixes it and flips it. That's a deal for both of us. The best part about my deal, though, is my $20,000 that I just made, because I entitled that offer or that purchase and sale in my IRA, is now completely either tax-free or tax-deferred based on my type of IRA. That's an incredible, and I made that money in 2 weeks. It's an incredible return when you think about it. So choose your financial goal, determine how much time and effort you want to put into it. Make sure you have an investment strategy and business model. A lot of time, if you don't have a lot of time, make sure that you've got a structure. So every year you need to make X amount of dollars. What's that as a function of return on investment? Definitely sign up with Entrust and work very closely with your representative. Follow their instructions. Your next step would be to choose a sponsor or an investment and learn to control your variables as best you can. The variables, like I mentioned, biggest ones are resale and what you can sell it for. In that case, you need to get some good team members on, some good realtors in your area that can help you share with you what it would sell for in top condition, as well as good contractors to help you control your budget, and you can duplicate it. So that's the big, huge benefit of real estate. You can make $20,000 to $30,000 to $50,000 a hit, which is either tax-free or tax-deferred, or if you don't have that sort of time, you don't want to be subject to those risks, just go in for passive buy and hold investing and invest for the long term. Invest to get a significant better return than, possibly better return than mutual funds, bonds, or stocks, and go for the long term with it. $250 per month per unit, or as best as you can make it. So that said, Jim, I really appreciate you having me today, and I see a lot of questions popping up, and I think you'll probably answer a lot with your presentation. But I'd love to turn it over to you, and if there's any questions, I can answer them at the end, after when you're answering yours.
Nick, thank you very much. Excellent job. 30 minutes, right on the nose. I'm going to try and keep my presentation to about 20 minutes. As Nick mentioned, we have a fair amount of questions. We're slotted for an hour, so I'd at least like to see if we can get about 10 minutes to handle questions. The Entrust Group, we are administrators for self-directed retirement plans. Our other key point that we like to present is that we're educators. We have national continuing ed credit programs that are available. We have national webinars like today. We have local webinars as well as local seminars because we have local offices. The Entrust Group is the premier provider of self-directed retirement plans. We've been in business over 30 years. Our CEO and founder, Hugh Broma, is a pioneer in the industry. He's published 5 books on self-directed investing, as well as having participated on most of the major financial new shows. We like to say our staff is knowledgeable. Many of us have the CISP, which is the Certified IRA Services Professional designation. That does include myself. Again, we're educators with about $2 billion in investor assets. The advantages of working with Entrust, as mentioned, we have local and regional offices. Most of our business development managers have experience. Myself includes 25 years plus in the financial services industry. Integrity we like to promote in the sense that we do not sell or promote any products, and that's important to know. Again, we have a robust website offering many different types of education, articles, recorded webinars. Our fees are competitive. Important to note that each account is FDIC insured. All of our employees of Entrust must keep current and take monthly compliance exams and pass them, again giving us the ability to be competent and professional. The benefits of self-direction. You can take control, as Nick had talked about. Many of our customers, I would ballpark perhaps as much as 40 to 50% are in real estate in one way or another. For those folks that are making their living in real estate, this is a great way to take control of your own retirement by doing what you do and know best. Diversification goes, as Nick had said, coming from the financial services world as myself. There's a whole other world beyond stocks, bonds, and mutual funds, and we give you that opportunity. Tax savings, you may be able to deduct contributions to traditional IRAs that will depend upon your income as well as marital status. And as well, tax deferred is going to be referring to your traditional IRAs. Tax-free growth is, of course, referring to the Roth IRAs. Investment choices, again, it lines up almost as I mentioned earlier. If you look at the left-hand column, that is in most ways real estate related, but it goes on. We literally have thousands of different types of investments that are made, including deeds, notes, precious metals, limited liability companies, partnerships, unsecured and secured loans, joint ventures, and life settlements. So we spend as educators, as business development managers, as people giving webinars and seminars, and working with our clients or prospective clients direct. We spend a fair amount of our time on what guides our industry, and that is the IRS Code 4975 that concerns self-dealing. I'm about to touch on some technical IRS definitions, but I always like to give, as I say, a Wall Street to Main Street explanation and analogy of prohibited assets, prohibited people, self-dealing. So for many of us who have brokerage accounts, let's say at Merrill Lynch, Morgan Stanley, Schwab, E-Trade, Fidelity, and let's say we look at purchasing a mutual fund, an AIM, an Ivy, a Janus mutual fund. Well, let's say we invest $10,000. It grows nicely. We make a terrific investment. Several years later, that investment has grown to $15,000. We decide to take a profit. That $15,000 we know and obviously realize and understand that that's going to come right back into the IRA, all of the capital investment we made as well as the profits. We wouldn't think to take any for ourselves personally, as we know that would trigger an early distribution as well as penalties. Same would go if the mutual fund spun off a dividend. If that income came to me, or excuse me, if the income was distributed from the mutual fund, it would go directly back into the IRA as opposed to me personally. Therefore, if I did, I would be taxed with penalty. And that really is the premise going forward with real estate. If you sold real estate that you bought in your IRA, all of the gains would go right back into your IRA. Any rental checks would naturally go right back into your IRA and not you personally. The two additional concepts that go with that is because it's real estate and it's a physical asset, you or family members, which we'll touch on, can never use that asset. And then the final point is the IRS distinguishes between intellectual equity and physical sweat equity. So you can be a property manager, you can oversee your investments in your IRAs just as you oversee your mutual funds. So you can locate property, you can make an offer, you can handle the closing, you can interview tenants, screen them, and collect rent checks. You can be a non-compensated manager. What you cannot do is pay yourself for that. And then again, the final point is where the IRS distinguishes between intellectual equity and physical or sweat equity. You personally cannot go in there and improve, enhance, or physically work on that property in any way. So let's go to the IRS definitions. We have prohibited assets and prohibited people. Prohibited assets really fall into a couple categories. Collectibles, as I like to say, art, jewelry, and baseball cards. Why? Again, because you can have personal use. The IRS is going to allow us tax preferential treatment to invest in things other than stocks, bonds, and mutual funds, but the IRS is not going to allow us to double dip, buy an expensive piece of art, and then hang that on our own walls. As well, life insurance obviously comes with tax preferential treatment. S-Corps is a business that we run that ultimately we file through our own personal taxes on an annual basis, and because IRAs are tax deferred or distribute tax free, that's not allowed. Disqualified persons, prohibited people, as I like to say, is straight up and down the family tree. So again, believe it or not, you are a disqualified person or prohibited person to your own IRA, as well as your spouse, your parents and or their spouses if they remarry, grandparents and or spouses if they remarry, your children and their spouses, your grandchildren and their spouses, as well as an IRA fiduciary. So straight up and down the family tree, ironically, brothers, sisters, nieces, nephews, aunts, uncles, cousins are allowed to do business with your IRA. Different types of IRAs. We deal with all of the traditional, the Roths, the individual Ks, the SEPs, and the Simples. It's just that our IRAs are self-directed. In other words, we're not a brokerage platform. We don't offer stocks, bonds, and mutual funds. We offer you the ability to invest in alternative assets that you've chosen, such as we mentioned prior, real estate, precious metals, privately held companies, etc. The two ways you can, actually 3 ways you can bring monies over into an IRA is through an annual contribution, number 2, a transfer, and in this case, where we seem to do a fair amount of transactions, is direct rollovers. Again, here, part of our job explaining and educating is to make sure if you go the direct rollover route, it must come directly to and in the name, it's a check cut, in the name of your new Entrust IRA account. If it goes to you personally, the IRS says we're going to assume that you're not going to deposit it into an IRA, and therefore we're going to take our cut, 20% federal tax withholding up front. So if you go the direct rollover route, oftentimes it can be faster, but it's so important, paramount, that it be done correctly. Annual contributions. This year in 2012, we've got a little bump in 2 of the categories. You'll notice there that these amounts are for those that are under 50 years old. You can add $1,000 if you're over 50 years old. All right, so let's look quickly at some rental case studies. A number of questions that come up. We're going to address these issues, and again, we can clarify them at the end with our Q&A period. But let's go ahead and get right into them for time's sake. So for the individual IRA holder who's going to buy a property with just simply the proceeds in their IRA, they're going to go ahead, in this case, they're going to look at a $100,000 property. They're going to transfer a little bit more money, in this case $125,000, so there's enough money to cover future property taxes, insurance, repairs. In this situation, it's the IRA that's going to buy the property direct. So John is going to initiate a contract to purchase this condominium, and again, the vesting that Nick had referred to earlier is going to be the Entrust group, for the benefit of. the person's name, in this case John Wood, and the IRA account number. Again, the most important thing here is that the purchase and sale agreement never be made out just in the name of John Wood. He completes a buy direction letter, which is our internal form, giving us the location of the property, the address, as well as the closing attorney. We're going to send the deposit, the good faith money of $5,000 to the title company and then coordinate the closing. Again, so important to know that you cannot make an offer on the property in your name with your own personal monies and then complete the transaction with your IRA. In some limited cases, and this is, we're not allowed to give advice, but to check with your realtor, there might be an opportunity to write into the purchase and sale agreement a reassignment clause where ultimately you're basically going to start over fresh with the contract, rewrite it in the name of your IRA. Any personal monies would be returned, and that would come from your IRA. But again, we defer to your real estate attorney as well as realtor if that can be done, which it can, but it must be done in the proper way. Let me get to the next page, excuse me. John is going to read and approve all of the closing documents. We facilitate the closing, but we do not do the actual approving of documents. That's going to be the IRA holder, in this case, John. The Entrust Group wires the funds to the title company to close. The warranty deed is recorded and sent to the Entrust Group for safekeeping. The SEP IRA is now the owner of record on the warranty deed, again in the vesting that we had talked about, Entrust Group, for the benefit of John Wood and his IRA account number. John is allowed to hire a property manager and pay the proceeds out of the IRA. Again, John is allowed to be a non-compensated manager himself. John locates a property manager to oversee this. The property manager will find the tenant to lease. They'll handle all the traditional duties of the property manager. In this case, John is, of course, able to track all of this via his online statement. Let's say 2 years later, John is able to sell the property for $150,000. He followed Nick's recommendations and metrics and did very well with the property. There's going to be a sales contract prepared for $150,000. The Entrust Group, once again, is going to handle this transaction in reverse. They'll coordinate the closing with the title company. On the day of closing, John reads and approves all of the closing documents. The proceeds, net closing costs, again, as we had talked about, is wired back into the IRA. These are a little bit close to the 2004, 2005 returns. But again, the initial investment goes back into the IRA along with 2 years of cash flow and the capital gains for a nice return. A lot of questions on buying real estate with your IRA with debt. So let's get into the specifics and then we'll handle some of the taxable consequences and terms. John's going to purchase a single office complex for $250,000 with his Roth IRA, and the seller is willing to hold a non-recourse note for $150,000. So John transfers his money from his brokerage account to the Roth with the Entrust Group to purchase the rental property. John initiates a contract to purchase the office, once again, with the proper vesting. John is going to complete the buy direction letter along with the contract, and we're going to send to escrow the deposit of $10,000 from the Roth to the title company and coordinate the closing. The title company prepares the HUD, the deed, and mortgage in the name of the Roth IRA, again with the vesting as we discussed. Documents reviewed and executed always by John, the IRA holder, and now the Roth IRA is the legal owner of the asset and responsible for the monthly mortgage payments. John can never be responsible or can never make those monthly payments himself personally. That would be a prohibited transaction. In this example, the purchase price is $250,000. Seller financing is $150,000. Balance due comes from the Roth IRA at closing for $100,000. Again, we go through the same process of John finding the tenants. He's allowed to be a non-compensated manager. It's leased for 2 years. Rents, as we discussed, must always go back into the Roth IRA account, never to John or never to John's business if he owns a real estate business himself. The Entrust Group deposits the rent payments into his Roth accounts. The mortgage payments of $875, again paid to the Roth IRA. Association fees, other expenses always must come out of the Roth IRA, and along with a positive cash flow. Once again, 2 years later, the lease expires. The current tenant offers to purchase the unit, so the transaction is handled once again in reverse of the way it was purchased. The contract is prepared for $395,000. The Entrust Group coordinates the closing. On the day of closing, the client, the IRA holder, always reviews all closing documents. The note is paid off, and the proceeds always sent back to the Roth IRA account. Once again, if we look at the initial investment along with cash flow from rental income and the gains, there's a nice return there that can be enjoyed within the Roth IRA. Understanding UBIT, unrelated business income tax. UBIT is a broad category of which debt financing falls under. Technically, specifically, UBIT refers to a situation where an IRA is acting as a business, and that business, because of a tax preferential treatment that an IRA holds, may operate as a business, but if it does so below market rates, the IRS says that's unfair to for-profit companies and entities, and therefore there is a tax applied to the gains. So if somebody bought a laundromat in their IRA and the going rate to do a load of wash was $5 and they charged $2, there would be an issue of the IRS saying, well, that tax-preferred entity, the IRA, is operating unfairly against for-profit entities. When an IRA buys real estate that's financed, there can be UDIF, UDIF, unrelated defined income financing, and that's where there's leverage going to be used. So in this case, there was a total gain of $125 from the sale. That portion was financed, so $75,000 may be taxed at the trust rate, not at the IRA holder's income tax bracket, but at the trust rate. Because an IRA is a trust, that falls under the trust rate of 30%. In this case, the likely tax is due $26,250 that must come from the IRA. So leveraged financing real estate in an IRA, if the market, if you're able to buy the asset at a good price, is not a bad thing. You just have to calculate in your metrics that there is such a thing as UDIF that exists. Utilizing an LLC for property. This is often referred to as an LLC checking account, an IRA checking account, having checkbook control. So in the examples that we used prior, John was just one entity that was buying one investment property. In the first example, when he was buying just a condominium with one renter. So in most cases, our clients will buy the property in the name of the IRA at the direction of Entrust. When people invest their IRA into an LLC, they're creating an LLC that's going to be owned by an IRA or multiple IRAs so that they can go down to a local bank, open up a business checking account in the name of that LLC, and then direct their IRA to invest into the checking account of the LLC. Keep in mind, the IRS Code 4975 always rules over this transaction. So the reason or the timing or the purpose of creating an LLC that's going to give checkbook control is when you have one, two, or three of all of the following. If you're going to have multiple investors coming together, if you're going to buy multiple properties, and or if you're going to have multiple tenants And then lastly, there is a fourth component where there's going to be a lot of rehab, repairs, and check writing. That's when most of our clients will utilize, create an LLC, open up a business checking account in the name of the LLC, owned by the IRAs, and invest. So in this case, John is coming together with 4 of his friends. So here's an example where there's going to be multiple investors. They'd like to buy an office complex, so you're going to have multiple tenants. So the way they're going to proceed is utilizing an LLC. It's important to know when you create this LLC, we are not in the position, or we do not approve the LLC in any way. That's important to note. We are basically reviewing the operating agreement of the document for 2 things. One, we want to make sure the vesting schedule, which defines the owners, is properly noted in the operating agreement. So if there's an IRA owner in this, as you see in the first several examples, that's noted as opposed to their names personally. If you notice, Kyle Bush and Donald Smith at the bottom are not using IRA monies, which is allowed. But it's distinguished, number one, which is IRA money and non-IRA money for tax purposes. Number 2, the initial capital contributions is forever going to define the ownership among the members. So, as we talked about, John, Jay, and Bob are using Entrust to utilize their IRAs, and then they're coming together with a couple investors that are non-IRA. The LLC is utilized to initiate the contract, so that's different than our first 2 examples. Entrust is no longer involved in the real estate transaction. The LLC is going to go out and make the offer and conduct the transaction in the name of the LLC. It's noted that any of these owners of the IRA are once again allowed to be non-compensated managers. Property management company can be hired. The property manager finds the tenants and handles all of its normal duties, as well as handling expenses. In the example, once again, to complete this, in the future they're going to sell the building. The proceeds are wired back into the LLC operating account. After the office complex is sold, the LLC, in this case, is not going to go forward to invest in other properties. They accomplished what they wanted with this particular property. Therefore, the LLC is dissolved. The prorated portions of the initial capital contributions get returned to the owners. And the first 3 gentlemen, in this case, the money will be sent back to their Entrust IRA. So in summary, IRAs can hold all types of investments, not just securities. Partnerships, split ownerships are allowed. IRA and individual plans grow tax deferred. In the case of traditional plans, tax-free in the case of Roth. All plans qualify and partial transfers are allowed. At this point, I'd like to open up and see if we can answer any questions.
We've got a lot of them.
Okay, Nick, if we can go to the top, let's see if
Sure.
we can just work through these.
Great. I think a lot of them might have been answered through your presentation, but we can start it there. The first one, Jim, for you, can the IRA holder ever live in an investment property? That's from Ross.
And again, the answer is no. The prohibited people start with yourself and then direct family members straight up and down the family tree. Prohibited transactions is defined as that prohibited person having any use, benefit, buying, selling, leasing, exchanging, or receiving any personal compensations. So no immediate family members up and down the family tree, including the IRA holder, could ever live in that property. Once again, nor could they personally improve it by fixing the back deck, painting the interior walls, or redoing the decorating.
Great. Next one. I know you guys probably just keep typing your questions in. That's going to be good. We're going to just take them from the top down as quick as we can here. Ken Mall, you, sir, are very real estate educated. What I did tonight in the real estate talk was I covered the very basics, the 4 basic strategies. He's asking here, Why not push seller carried notes? Another strategy in real estate is there's note buying and selling, but also just holding back a mortgage for a homeowner or for someone occupying a property to pay you a certain percent. So you are the bank. You are the lender holding that mortgage, and they're paying you the principal and interest. The one thing I would advise everyone on this call, and I'm not an attorney, of course, everybody knows, but there is now concerns with the SAFE Act. That's a federal regulation. So just make sure you check with an attorney. I know a lot of up here they're requiring a lot of those things to go through licensed mortgage loan originators, and we pay them a fee for that just to sort of clear them through that process. But that is also a very viable way to hold, and it's another investment. It's a paper investment that you would hold within your IRA, secured by real estate, but still it's a paper investment. Rajiv, oh, go ahead. No problem, Jim.
Was there anything else there you wanted to add? I'm sorry.
Nope. I was just going down the list again.
Next question, are you going to cover partnering with IRAs? And yes, that's very important. It's oftentimes a gray area, which is really pretty black and white. And the definition really is determined by the timing. So partnering, meaning that you could not partner with yourself by buying, let's say you have a family now with a 4-bedroom house. If you had a starter condominium when you went to college, your IRA could not buy that condominium. You could not buy a condominium for an adult child going off to college or for mom and dad retiring down in Florida. But you are allowed to partner with a prohibited person when and only when and if you all come together at the same time on an asset that is not previously owned nor has any interest by either any party or their IRA. So husband and wife can come together, let's say to buy a $100,000 property. The wife comes together with $50,000 from their IRA. The husband comes with $50,000. They can partner if they come together at the same time. So the timing is what distinguishes the whole partnering concept. Also, can you take depreciation mortgage interest deductions within IRAs? And, of course, no, because they're tax deferred.
Great. Jeff has one for you, too, I think. Is checkbook control more tax risky than having custodians process the checks? I love that question.
We handle that question quite often, and there's a lot of misperception and misinformation out there. One of the things that we hear or see that a checkbook IRA, quote unquote, if you will, is on the IRS Dirty Dozen list. And that definitely deserves some time, but I'll make it brief as possible. If you went to irs.gov and you looked at the Dirty Dozen or what gets on the IRS list, the majority of the issue with IRA abuses have to do with people who have traditional IRAs that own an asset, let's say a $100,000 property, and they want to convert that to a Roth IRA, ultimately because they can distribute that property in kind tax-free. So they get somebody to value the property as a knockdown to, let's say, $10,000. What happens then is when they convert the traditional to a Roth in kind, instead of paying $28,000 taxes on the $100,000 property, they're going to pay $2,800 on the $10,000 knockdown. That is obviously a flagrant abuse of an IRA. In the very last sentence of the paragraph, they talk about the IRS looking at prohibited transactions in IRAs that utilize an LLC. And the point is you don't need an LLC checkbook IRA in order to do prohibited transactions. In our first instance, when John bought the property in an IRA, if he physically improved the property, if he allowed his mom and dad to live in it, that would be a prohibited transaction. So what the IRS is saying is that they don't allow prohibited transactions with IRAs that are invested in or owned by their IRA into a checkbook. So it's important to know the difference there. Just like filing your income taxes, if you itemize and take deductions, if they're legitimate and you're doing the right things, you'll have no worries.
Awesome, great. I love that question. That comes up frequently when we do our talks, Jim, too. Great one. Joe, what about buy, wholesale, and flipping and carrying back a note? Are there any UBIT issues? And of course, being on the national webinar, Joe, I have to tell you, I'm not a CPA at all. What I can do, as we mentioned earlier, if you're wholesaling and flipping and carrying back a note, all within your IRA, and you don't take any personal gain from it, I would imagine, which I know is a dangerous word, that that's okay. But I can, I'm looking right now at the IRS.gov website for unrelated business income defined, and it says for most organizations, an activity is an unrelated business and subject to unrelated business income tax if it meets 3 requirements. Number 1, and this is Jim already went over this, it is a trade or business. Number 2, it is regularly carried on. And number 3, it is not substantially related to furthering the exempt purpose of the organization, in this case the IRA. So I know that was a safe answer to your question, Joe, but I'm hoping that that helped a little bit. And the next one I think might be for you, Jim. Steve's asking, can you lend IRA funds to an LLC you solely control?
If the question is the IRA holder owns an LLC outside of the IRA cannot do business with Joe or any business or entity he owns. That would be a prohibited transaction.
Okay, great. I'm going to give a few more too, going down to Mike Hoffman. To have an IRA LLC checkbook, that might be, I'll let you address that, Jim. I don't know if you want to do that online or offline.
There's 2 quick questions there. To have an IRA LLC checkbook, can I give Entrust only a portion of the funds from my IRA and leave the remainder with my existing brokerage firm invested in stocks and bonds? Absolutely. Again, we say invest in what you know. Your advisor is always a person that you want to defer to. Asset allocation is something that you and your advisor will discuss. So in order to have a portion diversified into real estate, precious metals, privately held companies, et cetera, that's for you to determine. So yes, you would only bring over whatever amount you were looking to self-direct at Entrust. And then number 2, explain about mixing personal and IRA funds. Again, we did cover that. You actually, I use the example of you and your spouse. You can actually come together and invest using your non-IRA funds, but again, it must come together at the same time into an asset not previously held by either party. And in that case, when there was non-IRA money and IRA money, there would be taxable consequences, of course, to the non-IRA money.
God, I'm happy I have you. Okay. Ken has a few questions down below. Will Entrust accept copies of a deed of trust rather than the original? That's a quick one, maybe.
We
you know that one
always need the originals.
What was that?
We always need the originals.
Okay.
And the next, can John accept any compensation for his property management efforts? Unfortunately, no. That would be a prohibited transaction. Again, having any benefit or compensation in any way would be not allowed. John could be a non-compensated manager, or again, he could hire an outside property manager and have the IRA or LLC pay for that.
Awesome. And Tom has a great follow-up to that. Can John be the property manager, hire no outside? No, he wouldn't do any sweat equity, but he would do all the banking, hiring workers, paying them. Go ahead, you can answer that one too.
Yeah, and then according to Thomas, again, what you're describing there in terms of doing the banking, the hiring of workers, paying them, that would fall into the category of intellectual equity. Yes, they are allowed to do that.
Great. There's a specific to California one in there. I'm not sure about that one either. From Ken. Is that an attorney question? Ken, I might be, I'll leave it to Jim, but I might be safe in saying, California, is there any form of cascading IRAs permitted? I love crazy stuff like that with my attorneys and CPAs get together and formulate these very complex strategies for me, but I'm not sure. I can't speak to that one.
That one would be deferred to a tax attorney.
Okay. Okay.
There's a question, any specific time frames relating to sale after purchase or how many properties can be handled this way? Would you be seen as a business within your IRA or still only as an investor? That's a great question. Again, you are allowed to be the manager of those properties, so as long as you're not receiving any compensation, there would be no issue. You can flip as many properties as you can make deals. We should probably wrap up, Nick. We're just about we're about 5 minutes over, so in the interest, if there's any other questions you'd like to handle, and then we'd like to wrap up and thank everybody for their time.
That would be awesome. Yeah, I think people do have our contact info, and they have your contact info. So if there are any further questions, feel free to you can shoot us an email, and Jim's is on the screen. But I really appreciate everybody for their time today. That's awesome. Great questions and some great info. So this is cool.
Well, Nick, thank you very much for your time. We greatly appreciate it. And most importantly, thank you everybody that is on the call today that took time out of their day to come and learn a little bit more about this. Greatly appreciate it. Welcome the chance to answer any questions. And lastly, Farah, thank you for your help in organizing and helping put together this webinar. Thank you so much.
Awesome. Great, guys. Have a great day.
Bye-bye.
Thank you. Please stand by.